All right, let's go ahead and get started. Guys, thank you all so much for joining us here today. We already have 51 people on the call. That's fantastic. Obviously, there's a lot going on that a lot of people want to hear someone's opinion about, and that's what we're going to do today. I'm John Norris. I serve as Chief Economist and Chief Investment Officer here at Oakworth Capital Bank. Also joining me today on the call will be David McGrath. He's our Chief Equity Strategist and Managing Director, located in our Lower Alabama office down in Mobile. And then also Sam Clement, who's Assistant Managing Director, as well as Portfolio Manager in our Central Alabama office, also known as Birmingham. What we'll do is I will talk about the economy for about 10 minutes, 10, 12 minutes maybe. I'm prone to go on a little bit long, so I apologize. I apologize in advance for my verbosity. And then after that, we'll turn it over to David to talk about what's going on in the equity markets and what we're seeing there. And then Sam will bring up the rear, talk a little bit about asset allocation and try to cover those things which David and I and our older age and senility have forgotten. Sam and his youthful exuberance will be able to fill it in nicely. After that, we'll leave plenty of room for questions and answers. I have set up the Q&A function on the webinar. So if you have any questions, you should be able to put them in. If not, just put them in the chat view, and we will get to them. We are going to answer questions after we're finished with our prepared remarks and all that good stuff. Also, do need to start off with a caveat, being that first caveat will be that everything that you hear today should not be considered or otherwise construed or deemed as an offer to buy or sell investment securities. Any action that you take independent of Oakworth Capital Bank today, based on anything that you see or hear today, you do so of your own volition. Markets can and will fluctuate, and our opinions are those of ours today, the investment committee of Oakworth Capital Bank, and not necessarily those of the company as a whole or any of its other shareholders, associates, stakeholders, all that good stuff. All right. That being out of the way, let's talk a little bit about the U.S. economy. Anyone that's spoken to me or read our newsletter or listened to our podcast probably knows that our forecast for the beginning of the year was not exactly exuberant. That's the second time I've used that word here today, but that's the way we felt about the economy. After a surprisingly strong 2024 and another decent, very strong year in 2023, what could the U.S. economy do for an encore? My goodness, monetary policy was relatively restrictive, and you just had to wonder just how much gas the U.S. consumer had, because savings rates were getting down there. Inflation was persnickety for such a long period of time, and you could see it in some of the numbers. You know, you heard some of the consumer staples folks talk about the exhaustion of the U.S. consumer, and I was beginning to see it and feel it in some of the reports. Then there was a little bit of just I don't know, maybe a B12 shock in terms of optimism after the election, and maybe that was going to be enough to steamroll us through the first half of the year. I was not maybe as sanguine because politics can feel good, but at the end of the day, the economy is what the economy is. It's how much money we have to spend and how good we feel about spending it. And our forecast was for the first 2 quarters of the year, the economy was going to be slower than it was for the last 3 quarters of last year. That's a pretty easy forecast. After all, the economy grew 3.0% during the second quarter, 3.1% during the third quarter, and still a surprisingly strong 2.3% or thereabouts during the fourth quarter. So it wasn't too much of a reach or stretch to say economy is going to cool a little bit from there. We're going to see the unemployment rate probably tick up a little bit. Labor market be a little bit softer than it was in 2024 and 2023, and inflation would probably start to moderate on its own. And I had told anyone that wanted to listen that by the middle of the year, the Federal Reserve would have as much ammo as it needed in order to cut the overnight rate more aggressively should it so desire. And at the beginning of the year, the markets were anticipating that the Fed was going to cut the overnight rate 2 times, two 25 basis point moves or 50 basis points all told throughout the entire calendar year. And thanks to the recent unpleasantness, all of that has changed from 2 on the Chicago Mercantile Exchange to 4, which is about basically where we were forecasting. Not necessarily that our crystal ball was fantastic. We just got there a little bit different way. We all knew that the president was threatening tariffs. We just didn't actually know just to the severity. Last week's Liberation Day came as a little bit of a shock. You might remember because, gee whiz, markets were up nicely that day and been on a nice little roll up until Wednesday afternoon. And then all of a sudden, everything fell apart. And it wasn't necessarily the fact that here it was again. Here's Trump talking about tariffs again. It was the enormity of the situation, maybe some of the vagueness of the explanation, and maybe some of the curiousness of the calculations on how we did this. We're going to start a trade war with the entire world, understanding that trade has always been good for economic growth in general. And it just really didn't quite compute for a lot of investors. And then we saw Thursday and Friday just absolutely fall apart. Yesterday wasn't quite so bad. David's going to talk about this in just a second. And then today we kind of gave up the ghost in late trading. But what does it all mean for the economy? I'll tell you that my opinion, the opinion of the investment committee in general, was that a lot of these threats of terrorists are really nothing more than using foreign policy cudgel, foreign policy disguised as tariffs and an economic cudgel in order to get foreign countries to do what we wanted them to do. We were finally going to bully up and use our economic might in the U.S. economy to get people to trade more fairly. And it's no secret. I mean, we've traded typically more fairly with the remainder of the world than the remainder of the world has with us. However, we take a look at it. Has that necessarily been bad for overall economic growth? And that's a great question, and one that I think you get a lot of debate about because you have to go back to the early 1990s to see when our trade deficit started to explode as a percent of GDP. And that's really kind of key there. What is our trade deficit relative to the size of the economy as a whole, as opposed to what is just the absolute size of the trade deficit? Back in 1992 or thereabouts, our trade deficit was around 55 basis points, 57 basis points of the entire GDP equation. Last year, it was over 3 percentage points. If you include services in there, I think it was 3.09%. So we've seen a huge spike in our trade deficit as a percentage of GDP. However, it really hasn't done that much since the beginning of this beginning of this century. It's hovered around 2.5 to 3% most years. During some years, it's gotten as high as 4% on any given quarter. But we've really kind of seen the trade deficit stable out relative to the size of the overall economy, even as it's grown in absolute terms. And right now, the number is pretty shocking, as you all know. So close to about $1.1 trillion last year. So when you take a look at that, it's kind of hard in absolute terms to go, my goodness, can't we do anything about it? And I suppose that's what the administration is trying to do. However, in starting a trade war with the entire world, that was kind of curious to me. If you read Common Sense last week, I wrote about how it's really primarily 14 countries with which we have all of our trade deficit, and really the top 10 account for the worst of it. And in order, in terms of our trade deficit, in 2023, we ran a $279 billion trade deficit with the Chinese. We ran a $152 billion trade deficit with Mexico, 105 billion with Vietnam, 83 with Germany, 72 with Japan, 66 with Ireland, 64 with Canada, 51 with South Korea, 48 with Taiwan, and 44 with Italy. That accounted for over like 900 billion of the 1.1 trillion. So the rest of the world, with the exception of if you add India, Thailand, Malaysia, and Indonesia to it, that accounted for something like 107% of the entire trade deficit in 2023, fully 14 countries, the vast majority of them being in Asia. So why pick a fight with the remainder of the world? And that's what the thesis was last Friday in Common Sense. And obviously, with how the markets were responding, that's what the markets wanted to know too. Why pick a trade with the trade war with the remainder of the world, understanding that trade has, again, historically always been good for economic growth. It always has been. Just almost by definition, it's the exchange of goods and services. It's also the exchange of ideas and technology. And we've seen the world's economy, the wealth in the world, grow exponentially over the last 30 plus years as the world economy has globalized. And as we have encouraged more free trade around the world, we have access to more goods and services. And even as our trade deficit has ballooned. moving forward, what it means for the U.S. economy if the intent is to bust up globalization, to get back to tariffs and protectionism, which I'm not sure that's the president's modus operandi here. We are in the United States going to come out better than a lot of other countries, even if we do feel a short-term slowdown in the economy as we consume less because goods from foreign countries are that much more expensive. When you take a look at the entire trading picture, in 2023, we exported over $2 trillion worth of goods. 18 billion dollars. Our economy that year was 29 trillion 724 billion. So our exports equated to 6.8% of overall GDP. Our imports that year were 3 trillion 80 billion, or 10.4% of GDP. Just doing some very basic math, when you add up all of our trade, imports and exports, that accounted to some 17.2% of gross domestic product. Conversely, when you take a look at our friends, say the Mexicans, and I won't go through all this because I'm going on long here, exports to the United States from Mexico equaled over 19% of gross domestic product in 2023. Their imports from the U.S. were 19%. Their exports to the United States were 28%. All told, when rounded, over 46.3% of the Mexican's economy is based on trade with the United States. So any sort of long-term trade war with the U.S. for the vast majority of our top 10 trading partners is going to have a much more profound economic impact on them than they will for the United States, since external trade isn't as important to our overall economic well-being as it is for our major trading partners, and frankly, it never has been. What that all means for the remainder of the year is, for the second quarter, until we sort this all out, until we level the playing field to the administration's, desired levels, we will likely see a relative slowdown in consumer expenditures. First quarter gross domestic product could very easily have a negative sign in front of it, but that was already established before last Wednesday. We could very easily say a negative sign in the second quarter, which would give us 2 consecutive quarters of negative GDP, which historically is normally the unofficial definition for a recession. However, the economy had pretty decent underpinnings before all this. Also, more than likely, what we will see is, because of a consumer slowdown, and because of the consumer slowdown, consumer prices will be falling. We'll likely see an uptick in the unemployment rate from 4.2%, maybe to 5%, but it's not going to be a double-digit type deal. We're going to see the Federal Reserve step in sooner rather than later, cut the overnight lending target, and that will give a nice little B12 shot in the arm. We could see the Fed get relatively aggressive depending on how rapidly economic situations deteriorate. I hated using that word. I don't mean deteriorate as strongly as the word will imply, but we could very easily see the Fed take the overnight lending target easily south of 4% by the end of the third quarter, which means that money will be that much cheaper, and we'll be in that much better shape. By that point, hopefully the negotiations that the administration is having with foreign countries will be over with, and we'll be back to trade as normal. You kind of wrap it all up, put it into a ball. Forecast is, and I do have a crystal ball in the office, the forecast is for a choppy second quarter. We're already well on our way with that after a relatively choppy first quarter. First 2 quarters of gross domestic product, at least the equation coming out of the Bureau of Economic Analysis, aren't going to look terribly pretty. Federal Reserve back half of the year is going to be a little bit more aggressive, give the economy some tailwinds, and we'll see the economy return to a decent level of growth, hopefully by the middle of the third quarter and certainly by the fourth, and we'll have much stronger tailwinds going into 2026. Very similar to what we were forecasting all the way back in December and January. What this tariff nonsense does is just maybe make it a little bit rockier and make the convictions that much stronger. So with that being said, I am now going to turn it over to David, who's going to talk about the economy. I mean, not the economy, we're going to talk about the markets.
Yes. Good afternoon, everyone. It has been quite a start to the year, and especially the quarter. And, John kind of touched on a couple of the points that I'm going to make as well, but, the stock market hates uncertainty. And what we've had over the last week are so many things that the stock market drives on have really been called into question. And how will all of this affect the corporate profit margins and corporate earnings? And we're going to find that out relatively quickly as earnings season starts in earnest on Friday morning. How much slower will the consumer be? The other thing is the labor market. Will companies look at all of this uncertainty and start to trim the labor force? You would certainly think that's the case. We got a jobs report just last Friday, and that kind of feels irrelevant already because things have changed so much in just a week. And then finally, with inflation, will tariffs put a floor under inflation, and what will that do to the Federal Reserve? John kind of already told you our thoughts with what the Federal Reserve is going to do, but there are questions out there on what will this have an effect on inflation. So I'm going to share my screen in a couple of charts with you. First, in a normal environment, this would have been a difficult time. But on this chart, what I'm showing is this purple line is the year-to-date performance of the S&P 500. The blue line is the average stock or the equal weighted S&P 500. So it shows really what most of the 500 companies that encompass the S&P 500 have performed. And this bottom line is the Magnificent Seven. We talked about the massive growth overweight for the last couple of years and how the S&P 500 is not nearly as diversified as it has been. And we've had really three events so far this year that have changed the market, and I've kind of put some arrows by them. The first was the DeepSeek story that came out, the Chinese AI that built a large-scale model in 3 to 4 months with $6 million. And most people didn't believe much of that story, but it called into question if you're spending $10 or $15 billion a quarter on your AI build-out, and you see a company that built a pretty decent looking model with 6 million, you may slow your spend a little bit. And so it called into question. You can see for about a month, the S&P 500 and the equal weight S&P continued to move up while the Magnificent Seven started to slow down. The next line here in the middle, this was the last all-time high that we saw for the S&P 500 on February 19th. The morning of February 20th, Walmart announced their earnings, and they said that the consumer is slowing down fairly dramatically. And Walmart reports that toward the end of earnings season. And I think every company just about that reported after Walmart brought down their earnings estimate for the rest of the year, citing the consumer is slowing down. What's kind of interesting is you can see the average stock in the S&P 500 did slow down some. We saw massive risk reduction where people were selling out of the Magnificent Seven. And then you can see what happened starting Thursday morning. And the average stock was just up a little bit. And I printed this at an hour before the close. So it's not exactly, but it's as close as I could get. The average stock fell a little over 10%. The Magnificent Seven fell about 10%. We've had, I don't know if you would call this indiscriminate selling, but people are getting out of the markets altogether over the last couple of days. So we've had three really strong headwinds that the market has faced. And I talked about corporate earnings season starting, and this is what makes it so difficult. So we're looking at 2024 earnings season quarters here, and here's what we're expecting starting with the first quarter. And, all of this turmoil happened toward the end of the quarter. So it's probably still going to be a decent actual earnings quarter this year. I think what you're going to see, we're only expecting about a 6.2% increase quarter year over year from 2014. But you can see the estimates start to get higher, 8.5%, 11%, 12% in the second, third, and fourth quarter. Very high probability these numbers are going to be brought down fairly dramatically or similar to what happened in 2020, companies stop giving guidance because it's going to be almost impossible to have any confidence in projected earnings for the rest of this year. I went back and looked at 2020, and we can all remember that day in early March where it was obvious COVID was affecting the whole economy. If you go back and look at earnings estimates from the beginning of 2020 to where they actually ended up, we were down 26% from where we thought estimates were going to be. I don't think that we can put necessarily the same impact as shutting worldwide economy down on what's going on right now. But if we did take 10 to 15% off second, third, and fourth quarter earnings, where does that get us? And you can see that brings us down to kind of a range 238 to 248. And considering 2024, we were at 245. So maybe right around the earnings that we had from last year, maybe slightly below. And we started at 22.3 times earnings on that 268 estimate at the high, which was at 61.44. We're now down to 18.5 times the 268 number. That number is most likely coming down and relatively dramatically over the next couple of weeks. I think that's going to be the next headwind that the market has to face. And so as we look back the last 2.5 years, we can see the dramatic returns of the Magnificent Seven. The average stock in the S&P 500 was up 15% for the last 9 quarters, let's say. And that is not a bad return, but it's not great. And you can see the impact of those 7 stocks more than doubled the return of the overall market for the last 2+ years. Another way to look at it, the Magnificent Seven at the top of the beginning of this year was 32% of the weight of the S&P 500. It's now down to 28. In the 2022 market correction, the Mag 7 started at about 22% of the weight of the S&P and is now down to 16. So I say all of that to say that it's more than just the overall market. There are several stories going on, and I think the massive overweight of that Magnificent Seven is part of it. We were very curious to see how much the consumer was slowing down before the tariff story really kind of destroyed the market over the last week. And now it's going to be hard to know if the consumer was slowing down before the tariff situation or how much more is it going to be affected by all of the noise that's going on right now. The good news is the defensive areas of the market are still performing relatively well. Healthcare is down 2%, utilities down 3%. I think consumer staples down about 1%. And maybe even more importantly, the bond market is actually doing their part. Unlike 2022, when the bond market was down almost as much as the stock market, if you have a balanced account, that bond portion is helping right now. So, there are some things that are still working in kind of a normal market sense. But all of this massive uncertainty, the sooner we can get through this uncertainty, the better idea we're going to have on what earnings could be. And the longer this goes on, the more actual impact you'll see from the consumer side and probably on the labor market side. So timing is important in how quickly we can get some answers. But it certainly feels like a very different environment now than it did a week ago. So that's all I've got. Sam, I'll kick it over to you.
Yeah, thanks, David. And I think that those charts David showed were kind of a good segue into what I was going to talk about with our asset allocation. In our strategies and the assets that we're managing, in the last call we did, in the last quarterly magazine we did, we've talked about for a while a few things and a few phrases you've probably heard us mention. The first one being broadening out, and that goes to David's point. That happens in both markets, and up markets and down markets. And David mentioned and showed the charts the impact that those Magnificent Seven names have had on the portfolio. And so that's been a trend that we've been positioning the portfolio to for really more than just the last couple of weeks or even couple months. Really over the last year, we've been trimming large cap. We've been trimming specifically large cap tech and really those Magnificent Seven type names in areas of the market, positioning for, again, just more of a broadening out. We've talked about the earnings the earnings multiples on some of these companies. And David mentioned the earnings on the market and the concentration in those names. And that significantly led the whole market up. And the flip side of that is that some of these areas, some of those more value type areas, frankly, didn't have that same high expectation on what these next couple quarters were going to be. The bar was not as high for a lot of these areas of the market. So over really the past year or so, we've been trimming areas in those higher PE areas of the market, the growthy areas of the market, the Apple, Amazon, Google, those types of names in the portfolios, and positioning really to an equal weighted growth to value, which again, back to David's point, is very against what the market has naturally done. The market has gotten very concentrated into large cap growth, specifically those 7 names, but large cap growth as a whole has become a much, much larger part of the market. So as that has naturally happened, we've been trimming that and kind of going against the direction that the market had been going for a lot of the past year. Starting this year, a trend that we talked about in the last call we did was about expecting volatility. John mentioned it with what the economy is going to be doing the first half. We felt like volatility was going to be returning to the market in some instance. I don't think anyone necessarily expected the last 3 days and how quickly it happened, but that's the phrase that we had talked about. And when we were talking about the portfolios, we were talking about a pickup in volatility, what we wanted that to look like in terms of our portfolios. And again, volatility is a natural part of it, and it goes both ways. And frankly, without it, you wouldn't have excess returns in the stock market. However, we wanted to position it at a time a little bit more defensively to position for the volatility that frankly hadn't happened for almost all of 2024, outside of about a 2-week period in the middle of the year. If you took a vacation then and didn't look at your accounts, you basically didn't feel volatility for much of 2024. And so expecting that to return, we did things like trimming small caps. We did that several times throughout the year so far this year. Doing that, small caps are down over 20%. They've led the way with that large cap growth area. And so really, in terms of expecting volatility to pick up, we focus on where are those areas that downside volatility impacts the most. And it's continued to be large cap growth and small caps, even trimming positions such as Apple in accounts without a significant tax consequence to it. And so all that combined was really our way of saying we don't necessarily know the extent of the volatility, but we're expecting just a normalization of it. And frankly, it's spiking right now. I think the VIX is above 50, so this is beyond normal. But again, last year we were less than normal in terms of the volatility in the market. So through the first quarter, really through the last couple of weeks even, that's what we've been talking about in portfolios. That's how we've been positioning them. Lastly, the last 3 days have flipped that very quickly. When we're talking about positioning for more volatility, getting a little bit more conservative, the last 3 days has been such a significant pullback that it's created opportunities for us to start dipping our toes back into it a little. David mentioned the quick contraction that's frankly been just over a couple days in earnings. And even if those earnings do come down, like we think will happen for a lot of these names, the decreased multiple that we've seen on the market has allowed us over the last 2 days to start dipping our toes back into the market, specifically the U.S. market. So I think to wrap it up with what David said, with what John said, we're still expecting this volatility to probably continue, at least for the remainder of this quarter. We're hoping to get some guidance of what the end result, like John said, is for these tariffs. But we want to see some kind of clarity on that and what a game plan is. I think markets can handle just about anything. They, at the end of the day, want to know what the rules of the road are and what the rules of the game are and how we're going to play, and then we can start to move forward. So that's where we're at right now. The quickness of the pullback in the market has created some opportunities for us to dip our toes back into the water a little bit, but we're still remaining, compared to where we have been historically, our equity weighting is I think the lowest or close to the lowest since I've been here. So again, last thing is we're not saying this is going to be a 2008 financial crisis, but we are, the impact of tariffs, even if they're walked back, there's going to be some impact from there. We've already started to see some cracks in the consumer a little bit, like David mentioned with Walmart. And so we wrap all this together, and things are probably not going to grow as fast as they had for the last couple quarters, like John mentioned. So we're not in this overly pessimistic environment, and we're not positioned for rack and ruin. But we still want to find those opportunities. We wanted to be defensive and have that insurance before we needed it. And as we get opportunities and as the market comes to us a little bit more, we're going to take those opportunities to start putting stuff back to work with a more long-term view. So that's where we are. I guess, John, I'll pass it back to you.
All right. Thank you for that. Good stuff, guys. Let me spotlight myself again. And Sam, I'm going to take you off the spotlight. And kind of cement what Sam and David have been saying is, yeah, this is going to be a choppy period of time. And but we were anticipating this year was going to be a little bit more difficult than last year and the year before. Money was very easy to get, was very easy last year and the year before. This year was always going to be tougher. These tariffs and the trade war that the administration has started over the last week or so just makes it that much tougher. I am of the belief, though, that maybe with the possible exceptional holdout of, gosh, the Germans don't want to come to the table, I don't think, and I don't think the Chinese do either. But pretty certain that everyone else will come to the table in some form or fashion. And I think the worst of any sort of slowdown in overall global economic activity due to this trade war will be severely mitigated by the end of the quarter. And as a result, this is not a 2008 type of economic scenario. And that's what people think of when they hear slowdown. They think 2008. They don't think, a 2-quarter slightly negative GDP forecast and all that type of stuff. So don't lose any sleep that we're revisiting the financial system crisis, at least not yet. That does not appear to be in the offing. In terms of the markets, we're going to bounce around in here. And as Sam said, we have already made a lot of changes over the last 12 months, and we'll be looking now for buying opportunities for some of that excess cash and short-term fixed income that we have been using and when we've gotten out of equities. That being said, we do have one question that's in the Q&A, and it's from our friend Tom Osborne. And Tom, you wrote, "It doesn't seem like the markets are acting like standard metrics and sound economic principles would suggest by responding to Trump's social media post. With that in mind, how does this worrisome downward trend reverse itself? Thanks, Tom." Tom, did you really write that? That is a very deep question, and I appreciate it. And I wish there was another question so I could answer that as opposed to this one. But I will tell you this, Tom, you're always going to have an element of that with retail trading, people following social media posts and going from headline to headline. That's just a function of trading in general, but more importantly, today's trading. I think the smart money, the large institutional money, even firms like ourselves, have already done a lot of the selling that they're going to do and are sitting on a much more sizable allocation to cash and just waiting for that retail investor, the people that are fear of missing out on the downward side, that are reacting to X posts and social media posts, determine whether or not they should buy or sell, waiting for those people to finally kind of give up in that regard. And once they have a pretty good feeling that that's happened, a lot of this cash that has been sitting on the sidelines is going to go straight back into the market. And you don't want to be sitting on the sidelines when that happens, at least not with all of your dry powder. So I think we're closer to the end of that big term freakout, Tom, than the beginning of it. But we'll probably have another couple trading sessions where you do still have some folks that are going to be moved by social media as opposed to reality of the situation. David, Sam, please tell me if you disagree.
No, I don't disagree at all.
David, you're on mute.
You did get another question, John. You could have avoided that one at first, but
So, is there another question out there? Y'all see any more questions?
yeah, you see, Corey Miller.
I don't see that one.
If you see
there
toward the top,
okay.
yeah.
I had to refresh. Hey, John, appreciate you taking the time to give us an updated outlook question. 10-year yields are back above 4% threshold. It's moved 40 basis points from the low of 3.9% in 2 days? Do you think yields pricing in higher inflation due to tariffs or China selling treasuries? At what point do you think yields moved lower, pricing in a growth slowdown driven by tariffs? Seems like tariffs are only inflationary up to a certain point. Long duration bonds seem like a decent risk reward considering the administration is squarely focused on yields for refinancing. That's a great question, Corey. Real good questions here. Generally, I like easier questions, and I think David and Sam do as well. It's the same joke told the second time. I'll tell you that my position on interest rates is pretty straightforward. Bonds, it doesn't matter if it's treasuries or corporate bonds, they're all subject to supply and demand. How much is it out there, and what's the demand for them? And they just can't get around it. And when the supply curve keeps on shifting out to the right, the demand curve has to as well, or else prices will fall. And when bond prices fall, interest rates go up. It is that simple. Bonds are really nothing more than math. Because of the massive amount of supply that we're going to have moving forward, even with Doge out there, Doge can hopefully shrink it, but even without Doge, it's still a massive amount of money. The last administration was forecasting that we would run up another $20 trillion worth of debt over the next decade. That's got to be financed somehow. And even if we shrink that to only by 50% and only shrink it to $1 trillion, that's still $45 trillion that we'll have to refinance. So there's going to be a lot of supply out there, and there's going to be a lot of pressure on longer term rates. And with that being said, unless we start really gobbling this stuff up, longer term rates are going to be higher than we would like. It's going to be a very long period of time before we get back to the 1.5%, 2% on the 10-year that we got used to for such a long period of time, unless something magical happens. And that is if the Federal Reserve starts buying bonds again. You have to remember from like 2008, whenever they started quantitative easing, 2008, 2009, until when they really, for all intents and purposes, stopped it in 2022, the Federal Reserve added over close to like $8 trillion worth of government-backed securities to its balance sheet. In that same period of time, foreign investors gobbled up an additional something like $4 or $5 trillion worth of treasury debt. So foreigners, including the Chinese, as you point out, Corey, foreigners as well as the Federal Reserve really did finance our profligacy coming out of Washington. And I don't see how we continue to run those deficits without one of those two players, or preferably both, continuing to gobble up treasuries. So I think we're going to have that supply problem for a long period of time that's going to put pressure on the long end of the yield curve. However, if and when it does get to 5% and trending higher, I think we are going to see the presumed independence of the Federal Reserve go completely out the window. And I do think that we'll start to see the Fed start adding to its balance sheet to keep that 10-year under 5% longer term or close to it. Near term, we could see the range of the 10-year Treasury be significantly lower due to lower overall economic growth, but we're not going to get back down to 4% mortgages or anything like that anytime soon. And right now, it really is just the best guess on just how much longer this volatility is going to last. So massive moves in the 10-year. I think we're going to be probably around this 4.3% range, plus or minus 20 basis points for probably throughout the summer. David, Sam?
Yeah, I'll just add one thing, and it really goes back to that supply-demand portion of it. The CBO, who does the government's projections for deficits, they've extended that projection out to 2055 and are expecting that deficit to run at that point at 7.3% of GDP. And the flip side of that is, so that's going to continue to be new supply. It's over $2 trillion per year for the next 10 years. I can't even do the math getting out to 2055, how ugly that's going to be. Add on top of that right now the estimates are that the interest rate on all federal debt held by the public is 3.4%. So we really haven't, the U.S.'s debt load and the interest on it, frankly, is still below where current interest rates are across pretty much most of the curve except newly issued debt. So to be able to refinance the debt at much lower rates, with most of the U.S. Treasury's debt not having a call feature, it'll require rates to be significantly lower pretty much in perpetuity. So there can't be much of a short term, let's pull rates down, let's refinance it. We're going to need to see rates much lower for much longer.
All right, another question. This one's a little bit more lighthearted. I kind of like it. Thank you for this. John, you seem to have forecasted this in some sense. Did you also forecast wearing a sweater in April in Alabama? If so, I trust anything you say. The quick answer to that is yes, Benton. I did forecast that. When you're trying to hide your gut, you forecast wearing things like sweaters during April. So I'd forecasted this quite some time ago, and depending on how the Battle of the Bulge goes over the next several months, we could be forecasting sweaters in June, July, and August as well. How about that? I got a question out there from our friend Sam Bate as well. It's in the chat function. Missed part of the presentation. What information out there is real and what is not real? Man, that's kind of philosophical. Sam, I would tell you that, I don't think this is what you meant, but I will tell you that I have less conviction in a lot of the data that's coming out of Washington now than I used to. I don't necessarily think it's nefarious on behalf of bureaucrats to feed the markets with bad data as much as I feel as though the methodology is broken or needs severe updating on a lot of these series, the CPI and the employment situation report being the two primary ones. The thing is just outdated. And I don't think it gives a good reflection of what prices actually are or what the labor markets actually are. So in terms of real and not real, I think most of it's real. I just don't think it's necessarily computed as effectively as it would, could, or should be. And I hope that makes sense. David and Sam?
Yeah, I think what's interesting right now is we are so politically divided as a country that when you have unknowns and you have ranges of potential outcomes, depending on what side of the aisle you argue your politics, you can use some pretty ugly numbers one way or the other, and it's pretty hard to refute it right now. So I think part of that is, rooting for one side to lose rather than focusing on what's really best for the country moving forward. And the cloudiness of everything that's going on right now makes that more difficult to refute one way or the other.
All right, we've got some minutes to spare for everyone that wants to stay on and ask some more questions. Please, by all means, use the Q&A function right up there at the top. Type it on in, and we can hang on for a few more minutes. All right. Give you all another minute or two before to put something in there in the Q&A function. All right. Well, I guess we answered all the questions with our comments, but guys, we really do appreciate you all. Appreciate you all as clients and as friends, and we are sorry that we have to have calls like this because it means generally that things are going not maybe as envisioned or as desired in the markets. Just to know that sun's going to come up in the east tomorrow, no matter what we do today, and this too shall pass. And a year from now, if not much sooner than that, we'll be looking at this as just a blip in the road. This great country in which we live and a very promising future, and invest wisely and for the long term, and treat it as a marathon and not a sprint, and you will have superior results. So with that being said, I hope you all have a great remainder of the day. And again, thank you for everything. All right. And now I think I can turn it off. All right, my friend.